Welcome to Balance Sheet Basics. Upon completion of this training, you will be able to define a balance sheet and identify its key components, calculate working capital on the current ratio and explain their significance in evaluating a firm's ability to manage short-term obligations and maintain financial stability. Categorize different types of assets, current, intermediate, long-term, and liabilities, current, intermediate, long-term, and explain their impact on the firm's financial structure. Calculate the firm's net worth by subtracting total liabilities from total assets and discuss its importance in determining the overall financial health of the firm. A balance sheet is a snapshot of your firm's financial health at a given point in time. A balance sheet describes what you own or your assets, what you owe or your liabilities, and the relationship between the two. A balance sheet is the first step in building a solid financial foundation. There are several different reasons it's beneficial to use a balance sheet on your firm. First, a balance sheet provides a point of comparison that allows you to compare how your firm is doing from year to year. Second, a balance sheet also provides a data snapshot by outlining your assets, your liabilities, and what you'd have left if you sold everything. Third, a balance sheet can be used as a monitoring tool. In conjunction with other financial documents, a balance sheet aids in evaluating and managing the financial health of your firm. Finally, a balance sheet can be used as a communication tool. You can use a balance sheet to convey your current financial status to both internal stakeholders and lenders in your business. Now that you understand how a balance sheet can be used, let's look at specific calculations using the figures shown in a balance sheet. By showing your assets and liabilities, your balance sheet shows your operations liquidity. An operations liquidity reflects its ability to repay short-term obligations when they are due by looking at cash on hand and liquid assets, which can quickly and easily be converted to cash. Common measurements of liquidity are working capital and current ratios. Working capital shows you how much money you have to pay debts coming due this year, to pay unexpected expenses, and to save for the future. To calculate your working capital, subtract your current liabilities from your current assets. While each operation is different and your needs for working capital will vary, it's generally advised that most operations maintain a working capital of at least 15% of its gross income. This can provide a buffer during periods of reduced profitability. The second measurement of liquidity is current ratio. Your current ratio is your current assets divided by your current liabilities. This figure shows the relation of your current assets, cash on hand and liquid assets, to your current debts due. Unlike working capital, this metric is more suitable for benchmarking your operation against the performance of similar operations. Each operation is unique. It's generally advised to have a current ratio of 1.25 to 1 or greater. This means that your cash and/or liquid assets should exceed your current debt by 25%. While benchmarks and industry standards are helpful tools, discussing your operation's particular goals and needs with trusted advisors familiar with your operation is helpful. Now let's dig a little deeper into assets and liabilities. Remember, not all balance sheets look the same. Use a format that works for you and your lender. However, it's important to understand where you will list different types of assets and liabilities. Both assets and liabilities are divided into current, intermediate, and long-term. The sum of all asset types minus all liabilities types determines your firm's net worth. First, we'll look at the different types of assets. Current assets are cash on hand or anything that will likely become cash or be used up in the next year. Current assets include cash and savings, accounts receivable, marketable securities, livestock and commodities, investment in growing crop and prepaid expenses, and supplies on hand. Intermediate assets are assets with a useful life of more than 1 year but less than 10 years. Intermediate assets include breeding livestock, machinery and equipment, retirement accounts, securities, and non-marketable accounts, and cash value of life insurance. Long-term assets are assets with a useful life of more than 10 years, such as land, buildings and real estate, and farm credit stock. Liabilities are also divided into current, intermediate, and long-term. Current liabilities are debts and payments due within the next fiscal year. These include accounts payable, accrued interests on all liabilities, rent, leases, operating loans of less than 1 year, income tax and real estate tax, credit card debt, and principal loan payments due this fiscal year. Intermediate liabilities are debts that will be paid off in more than 1 year but less than 10 years. Intermediate liabilities include machinery loans, life insurance loans, car loans, and student loans. Long-term liabilities are debts that will be paid off in more than 10 years. These include mortgage and real estate loans, construction loans, and land contracts. Now that we've covered what a balance sheet is, what it includes, and how it is used, let's review some of the basics. Do you remember how you can use a balance sheet to help manage your farm's finances? The balance sheet can be used for comparison to show how your farm is doing from year to year. It can also be used as a data snapshot of your assets and liabilities, and as a monitoring and communication tool to help you evaluate your farm's financial health and to convey this information to others. Thinking about what we learned about current ratios, as a general rule, what should your farm's current ratio be? Even though each farm operation is different, it is generally advised to have a current ratio of 1.25 to 1 or greater. This means that your cash and/or liquid assets should exceed your current debt by 25%. Now let's review the different kinds of assets and liabilities. You'll remember that assets and liabilities are divided into current, intermediate, and long-term. Which of these are current assets? Current assets include cash and savings, accounts receivable, and marketable securities, livestock and securities, and supplies on hand. Which of these are intermediate assets? Intermediate assets include breeding livestock, machinery and equipment, and retirement accounts. Which of these are long-term assets? Long-term assets include land, buildings and real estate, and farm credit stock. Thinking about the 3 categories of liabilities, can you recall examples of what goes in each category? Which of these are current liabilities? Current liabilities include accounts payable, rent, leases, and operating loans or less than 1 year, taxes, and loan payments. Which of these are intermediate liabilities? Intermediate liabilities include machinery loans and life insurance loans. Which of these are long-term liabilities? Long-term liabilities include mortgage and real estate loans, construction loans, and land contracts. A balance sheet is a crucial tool for assessing your farm's financial health, offering a snapshot of your assets, liabilities, and overall net worth. It helps monitor liquidity, manage finances, and communicate your farm's status to stakeholders. Understanding and using a balance sheet effectively can strengthen your operation's financial foundation. Now that you understand the components of a balance sheet and how to use it to evaluate your farm's financial health, you can use these tools to better manage your farm and build a solid financial foundation. Now that you understand the components of a balance sheet and how to use it to evaluate your farm's financial health, you can use these tools to better manage your farm and build a solid financial foundation.